On Point with Craig's Investment Partners.
All right, good morning, all. Remember, the information provided here is general in nature. It's not financial advice. It doesn't take into account your situation, circumstances, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So, before you make any decisions, you should always contact an investment advisor. And you can find out more about our services in that regard at our website, which is craigsip.com. All right, the beginning of another week. Let's first look back on some of the key events and moves from last week, and then we'll have a little discussion about what is coming up in the days ahead. So, last week, first week of the third quarter of the year, first week of the September quarter, after we put the sort of June 2023 quarter behind us. And markets were off the boil a little bit, but there was a bit of weakness across most equity markets. The US was down a little more than 1%, the UK and Europe down 3.5%, the Aussie market off 2.2%. Our little old market here in New Zealand actually bucked the trend and managed to eke out a 0.5% gain. So that was good to see. Not always not hugely surprising. You often see that when international markets are just a little bit shaky. Our market can often prove to be a little bit more defensive and hold its own a little bit better. I don't think we should panic about that too much. It's not unexpected to see a bit of weakness creep in, especially after the very strong first 6 months of the year that we had. It was a stunning first half of the year. You had world shares up 12.8%, which is a very strong performance. Over a 6 months. Just over a 6 month period. That's the strongest half. If you look at all the sort of first half, second halves going way back, that's the strongest half we've seen since the second 6 months of 2020. And that was, of course, when we were rebounding from COVID. The vaccines were starting to get rolled out. We'd had that period of weakness earlier in the year, and all that stimulus was in place. So you had share markets and other markets sort of rebounding strongly. So strongest 6 months or first half or half, I should say, since then. And even if you go back sort of over the last 10 years, there's probably only 3, maybe 4 occasions when we've had a stronger half than that. So look, it was a great start to the year. Not everything went up as much as that. You had the Japanese market that was very strong. You had the US share market that was very strong. The S&P 500 finished the first half up 15.9%. Europe was pretty strong, up sort of 8 or 9%, but other markets were a bit more subdued. Emerging markets up just 3.5% over the first half. The UK was only up about 1%, and the NZX 50 here in New Zealand was up 3.9%. So, look, it hasn't been sort of a case of all markets roaring ahead across the board. There have been some definite pockets of strength. Japan, the US, largely driven by the tech sector and the AI stocks and sectors and that sort of theme. Europe, not too bad, but others have been a little bit more subdued. So maybe that's one reason why our market has held its own in this first week of the third quarter, because we didn't sort of rocket ahead as much as others did. Interest rates were where the big stories were last week. At least we had some big moves in interest rates in the US. We had the 2-year Treasury bond yield rise from about 4.9 to about 4.95, but actually at one point during the week it went over 5.1%, which is the highest that we've seen since about 2008. It didn't close at those levels, but it pushed higher during the day. So a hefty move there. US 10-year Treasury yields are sitting above 4% again now. It's been a little while since we saw that. And here in New Zealand, it was a similar story. The 2-year swap rate, which is a wholesale market rate, rose from 5.5% to 5.75, which is a big move in 7 days, and I think that is actually the highest we've seen since 2008 as well. The 5-year swap rate up also up from 4.7 to just over 5. So not as big a jump, and it's still at the highest levels we've seen since October last year. But it was really those shorter term rates in New Zealand and the US that pushed up a lot higher, and that happened for a few reasons. We've had some half decent economic data that looks quite good, quite solid, and markets have started to account for a potentially more aggressive tone from some of the world central banks over the coming months. So even though we do generally feel like we're getting pretty close to the top of the hill in terms of the cash rate increases around the world, and we've got a decision this week here out in New Zealand. We'll talk about that soon. There's still risks that central banks have to work a little bit harder and do a little bit more, and that sort of dawned on people. Over the last sort of week or two, and we've also had share markets that have powered ahead and have been very strong. So that was sort of the setup, I think, for a little bit of caution to creep in. Looking back at last week and the key releases, we had a lot of US data. We had the ISM indices for June. These are the Institute for Supply Management indices. So you get a manufacturing one, you get a services one, which covers all your bases. The manufacturing sector in the US still very weak. The ISM index for the manufacturing sector, at least, was 46. 50 is your break-even point, and we've been under 50 for 8 months now, 8 consecutive months. So the manufacturing sector very much is telling us that there's a recession. Obviously not across the board, because you've still got services that are looking strong, but in the manufacturing sector things are very recessionary. So that was the lowest since May 2020. The services sector continued to look strong. The services ISM rose to 53.9, so that's above that 50 break-even level, and that's actually the highest since February. It was ahead of forecast. So you've got some good and bad there. Services doing all the work and all the heavy lifting in terms of economic activity, and manufacturing still very soft. So in aggregate, things aren't too bad, but you've got increasing divergence between different parts of the economy. You could probably say the same for New Zealand at the moment, couldn't you? There were some positives to come out of those ISM releases. The manufacturing new orders index, which is a good leading indicator for what's coming, that improved a little. And we saw the same for the services new orders index. That was very strong, actually. And you had some of those inflationary indicators like the prices paid index, which is essentially what factory gate prices. So a very good gauge of where inflation is headed, because factory gate prices are higher. Manufacturers will factor that into their selling prices, and it ends up with us as consumers. But that was down. It's actually at the lowest level we've seen in about 3 years, which is good news. We had the June jobs report out of the US. This came through on Friday night, so we got it on Saturday morning. Bit of a mixed bag. At the headline level, a bit softer than expected. 209,000 new jobs created in June. People were expecting 240, so a little bit behind expectations. That's a little bit surprising, because earlier in the week we did have some other figures that showed a very strong gain in monthly new jobs, but different data does sometimes paint a slightly different picture. Excuse me. Unemployment rate fell back to 3.6, so that's down from May. May it was at 3.7, but it's still above the lows of this year. The lows of this year, about 3.4% in the US, which is the lowest we've seen since the 1960s. So you've still got a very tight labour market, even though unemployment has pushed up a little bit, and even though you've had a slightly softer number of jobs coming through. So that's probably what the Federal Reserve wanted to see. Unemployment still off the lows, just a little bit of softness in the market, but at the same time, wage growth was a bit stronger than expected. That's sitting at 4.4% for annual wage growth in the US. That's using the average hourly earnings. So that still points to inflationary pressures ahead, particularly in the services sector. So yeah, you can take that sort of data set however you want it. There's some positives and there's some negatives. The next Fed decision, interest rate decision out of the US, is in a couple of weeks' time, few weeks' time, the 25th and the 26th of July. At the moment, financial markets see one further interest rate hike coming. They're at 5.25, so the market sees one further hike. And the chance of a second one beyond that. But they're certain that we'll see that one further hike. So we'll have to see what comes out over the next couple of weeks. We've got the inflation report out of the US this week, which will be quite crucial in the sense that does the Fed move in July and then that's it, or do they move in July, take another break, move again later in the year, which is sort of what they've guided to. But just like all of us, they will react or change their stance as sort of new information comes to hand. So we're definitely approaching that zone where many of these central banks are close to done, but it's unclear whether they're quite done. There might be a little bit more still to come. And that was a similar story from the Reserve Bank of Australia as well. They had their decision out last week, no change. So they just left their cash rate alone. They're at 4.1%. So they're less than us here in New Zealand. We're at 5.5, less than the US, which is a 5.25. But they are playing a bit of catch up. And there's still an expectation that there's 2 or 3 more rate hikes to come across the Tasman. So that would put the RBA cash rate in the high fours, call it 4.6, 4.85 if we're working with 25 basis point moves as a peak. So that would still be less than the US, still less than New Zealand, but it would be up from where they're at today. So that's something we'll be watching as well. Here in New Zealand, the key release from last week was probably the QSBO survey. That stands for Quarterly Survey of Business Opinion. The NZIER releases that, and very good survey, very credible, been around for a long time, closely watched by economists, financial markets. Only comes out quarterly, so it's basically a sentiment survey, business sentiment, very similar to the ANZ Business Outlook survey, which listeners will know that I watch very closely. I find that one more useful because it comes out more frequently. But the QSBO is very good too. And it was largely as you'd expect. Overall confidence up a little bit, but still off a very low base. Trading conditions a little bit softer. That kind of makes sense. The economy's slowing. Importantly for our Reserve Bank, signs in this report showed that labour market conditions were easing a little bit. So businesses they're not finding it quite as hard to get staff, particularly compared to 6 months ago, 12 months ago, 18 months ago. Still hard to get staff, but not as hard. So you're just starting to see the labour market ease up a little bit, which very much bodes well for inflation. And it means that some of the wage pressures that we've seen over the last year or three will be coming off a little bit. And I know on the one hand, rising wages are good because a lot of jobs in New Zealand deserve to be better paid. So there's nothing wrong with higher wages, especially when you've got a cost of living crisis, which we have had. But when there's all those wage pressures out there, businesses just pass those on, and then you're in the spiral where you'll never really get your inflation under control. So for the price rises just in goods and services and general inflation to stop, for prices of things to stop rising, for us to get that cost of living crisis under control, we actually need to see some of those wage pressures just reduce a little bit. So it's a bit of a double-edged sword. Looking ahead and sticking with New Zealand, the Reserve Bank will be the highlight this week. They will announce their latest monetary policy decision on Wednesday at 2:00, and this is just a monetary policy decision. They used to call them just OCR decisions rather than it being a full monetary policy statement. So the difference there, they sort of alternate, and they always sort of have the right to sort of change the OCR or not change it. But the monetary policy statements are a bit more important because they release a whole new set of forecasts. So that's when they have the opportunity to change their mind about what they see in the future. And this week is not one of those. So all you'll get is the OCR up, down, no change. It'll be no change. you won't get sort of any real new detail about their train of thought. You'll get a relatively brief statement. So we're at 5.5% for the OCR. I don't think it'll change this week. The Reserve Bank is in watch and wait mode. They've done a lot in the last sort of 18 months. In fact, this will be the first no change since I think August 2021. And at every meeting since then, and there's been, I think, 12 of them, they've raised the OCR by some magnitude. So this, it's been a while since we've had a no change OCR decision, but I suspect we'll get that this week. They're in watch and wait mode, all going to plan. They've done enough. Their forecasts suggest that the OCR is at its peak. Not everyone agrees. A few economists think they might need to sort of push one more through. I tend to think that they are probably done. If I had to put money on it today, I would say the OCR is already at its peak, and from here it just goes sideways before eventually sort of falling. That'll probably be a story for 2024, and that's one of the reasons I'm very much glass half full about the New Zealand share market. Certainly not out of the woods. Plenty of risks, plenty of challenges, but it's a huge development that the OCR increases are behind us, and that now we sort of reached a bit of a plateau, because I think by the end of this year, financial markets, which always look ahead 6 months, 12 months, 18 months, we will be talking about when is the first cut, and that probably bodes well for the performance of our market, and certainly puts it in a better position than we've been in for the last 18 months, 2 years, where it's been a case of interest rates have got to go up, and they've probably got to go up a lot, and we have no idea sort of where they get to. Now it feels like we know where they get to. So that will be the big one, the RBNZ on Wednesday, and we'll be interested to see whether their view is similar to the one that I've just articulated, or whether they've got more nervous, less nervous. The next big release for them is probably the June quarter inflation figures, which I think are out next week. I want to say the 19th of July. So June quarter CPI out next week. Our inflation peaked at 7.3% headline inflation, annual growth, or the annual change, about a year ago. So it's now sitting at 6.7%, and the Reserve Bank expects it to fall to 6.1% in these coming figures. So we'll have come down from 7.3 to 6.7 to 6.1. They've got it slipping into the 4s by the end of the year as well. So that's what's sort of in their numbers. That's their expectation. I wouldn't be surprised if it falls a little bit quicker than they're expecting. It could well be sort of in the high 5s when it comes out next week. So that's probably equally as important as what we hear from the Reserve Bank this week, because like us, they will be watching for that inflation report. And if it's a little bit softer than expected, that will just firm up expectations that they have probably done all they need to do. So that's the highlight for us this week, the Reserve Bank, and then next week it's that inflation report. Also on Wednesday, we've got another dairy auction, so that will come out first thing in the morning, obviously very early. Last time we saw a fairly decent fall, down a little bit more than 3%. So global dairy prices, like many commodities, have been pretty weak this year. Global dairy prices off about 8.5%. They hit a 15-year high last March. So March 2022, they were at the highest since 2007. And they're down almost 40% below those levels, below where they got to last March. So now they're back at about late 2020 levels, November-ish 2020. So we'll get some new figures out Wednesday morning. Migration out that day as well. So it's all about Wednesday. You'll get the dairy auction, you'll get the RBNZ, you'll get some migration figures too. We might see a housing report from the Real Estate Institute this week. They usually come out on business day 9 or 10 and of the new month. And Thursday, I think is business day 9. So we might get it that day. The next day is Friday, obviously. We've got the public holiday. So business day 10 would mean we're pushing into next week. So, who knows? But I've talked about my thoughts on the housing market before. I feel like we're close to a bottom. I feel like from here things will stabilise. That's fantastic from an economic confidence perspective. But at the same time, look, don't get your hopes up about the housing market racing away on us again. Still plenty of headwinds that aren't going away anytime soon. You've still got mortgage rates that are sort of around the 7% level, the highest in 15 years. You've got an election that's creating a lot of uncertainty. You've got an economy that is going to slow from here. So still lots of challenges that will stop the housing market, rocketing ahead. But I think it'll stop falling, and maybe we'll sort of just push a little bit higher, once we find that bottom. So we'll just wait and see. Internationally, the key event will be the US CPI report, Consumer Price Index, inflation. So that's out on Wednesday, and this is probably the big event for financial markets around the world. For us, it's probably the Reserve Bank, but out there in the big wide world, all eyes will be on that US CPI report on Wednesday, especially as we head to that Fed meeting at the end of the month, and with the markets now quite confident that we'll see a rate hike. If there's anything that's going to change people's mind and make people less convinced that you'll see another Fed rate hike, it will be this US CPI report. So if the CPI comes in weaker than expected, softer than expected, that could sort of make people rethink that, because they'll be thinking, well, hang on, maybe the Fed will just sort of, pause for thought as well. The annual headline inflation rate is expected to fall to 3.1% in June. Isn't that amazing? It was 9.1% in the middle of last year, the highest since Ronald Reagan was in office in the early 1980s. And now they're expected to have got it down to 3.1. That'd be a big fall, obviously from those levels, but also from last month when it was 4.0. So that's where people are at for headline inflation, 3.1%, lowest in more than 2 years, and well down from the highs. Core inflation, which excludes energy and food, that is proving more of a problem. That is still very persistent. You've got the services sector that's still performing very well, very strong, lots of wage pressures there. And core inflation is more linked to those parts of the economy. So it's still expected to come down, but only to 5% from 5.3 last month. So that's still good news. That would be the lowest since late 2021. But 5 is still, sounds a lot. If you're a central banker, you're much more worried about 5 than you are 3.1. 3.1, you're starting to get confident. You're sort of nearly in that sweet spot of sort of, 2 to 3-ish. But at 5, you're still, more than double where you want to be. So that will be closely watched. We'll be keeping an eye out for that on Wednesday. And last but not least, the reporting season begins this week. So the corporate reporting season for international companies, that is, not for New Zealand. Our next reporting season is in mid-August, so we've got sort of about 4 or 5 weeks before companies start reporting here. But the international quarterly reporting season will begin this week. Lots of things to watch there. We'll be watching revenue growth for any evidence of a sharper slowdown than we're hoping. We'll be watching company margins, given the cost pressures that are still very prevalent. We'll be watching the banks after the events of earlier this year. How are the regional banks looking compared to the bigger banks? Anything we can learn from that. A lot of those tech stocks will be in focus, simply because they've had such a stellar run. So you've got some share prices that are getting up there, and that's a good thing, especially if you own those stocks. But it also means that when it comes time to report your earnings, investors will expect results. So the bar is a little bit higher, and there's a bit more room for disappointment if any of those companies that have performed very well can't back that up with strong cash flows, good earnings, good growth, and positive guidance. So we'll be keeping an eye on all of those things. Overall, for the June quarter, because this will be results for the June 2023 quarter, so the one that's just finished. They come out quickly, don't they? We're expecting, or the market is expecting, to see earnings fall about 7% relative to the same quarter a year ago. So if you compare the June 2023 quarter versus June 2022, the expectation is that in aggregate, on the whole, you'll see earnings fall about 7%. So, some will hold up better than that. Some will still still exhibit growth. Some will see bigger falls, but in aggregate, the whole S&P 500, that would actually be the biggest decline, quarterly decline since 2020. Right in the middle of the pandemic, when we saw corporate earnings fall about 30% year on year for one of those quarters. I think it was the June 2020 quarter that was the really ugly one. So that will be interesting too. As always, it's the same group of stocks that usually kick us off for the reporting season. So PepsiCo, Delta Airlines, they report results on Thursday. So that's overnight Thursday for us here in New Zealand. They're obviously exposed to the consumer. So, you learn a lot from all results, but different things from each of them. So that's Thursday. Friday, a lot of banks reporting: JP Morgan, Citigroup, Wells Fargo. So those will be overnight on Friday night. We'll get those results on Saturday when we get out of bed. United Health, which is a big healthcare company in the US as well, reporting on Friday. Over in Europe, Burberry was the only big name sort of on my list of companies that have a result to share with us. But that will things will ramp up in that regard over the next 2 weeks, 3 weeks. So you are going to get a landslide of corporate earnings releases from overseas next week, the week after, and you'll get all the sort of household names, the Teslas, the Microsofts, the Apples, the Amazons, all of those big, massive companies, 3M, Caterpillar, McDonald's, Coca-Cola, all of those huge behemoths. And it will be interesting to see how they're tracking, especially given that the market has performed better than many would have expected over this first half of the year. That's all I had to say. Look, if you did miss the podcast that I did about 10 days ago, just wrapping up the first half of the year, looking ahead to the second half of the year, go back and take a look. It was an interesting one. It was always interesting to take stock when you're at the halfway mark, and you'll find lots of comments and thoughts in there about what the market did over the first half of the year. I'm talking about all markets: global markets, bond markets, share markets, currency markets, everything under the sun. But more importantly, where do we see them going? What am I thinking about and focusing on for the next 6 months? Because there are challenges. There's always challenges, but there's also no shortage of opportunities as well. So if you are looking for fine-tuning opportunities in your portfolio, or if you just want to know what you should be keeping an eye on, or any of that, then make sure you do dig out that podcast about what did I call it? A mid-year market stock take or something along those lines. Definitely worth a look. Easy to find, and you will hear all my thoughts about how I think we're positioned at this point. All right, thanks all. We'll stop there.
For more insights, visit craigsip.com.